So, when you think of Warren Buffett, what comes to mind? Probably some guy glued to a screen full of blinking charts, right? Making these frantic, split-second trades. Well, what if I told you that the way he really reads the market is the complete opposite of that? Let's dig in and find out how he actually does it.
All right, let's just rip the Band-Aid off and bust this myth right away. On one side, you've got this idea of the market timer. You know, the guy frantically watching CNBC freaking out about every little chart wiggle. But the reality? It's the business owner. This is someone who reads annual reports, who actually studies the value of a business and then just waits. He waits for the market to offer him a great price. It's a totally different game.
And that really brings us to the first huge pillar of his philosophy. It's not about what he pays attention to, it's about what he chooses to ignore. Think about it. While everyone else is caught up in the day-to-day chaos, Buffett is just tuning it all out.
And this quote, man, it just says it all, doesn't it? The stock market is designed to transfer money from the active to the patient. He doesn't see all that daily market craziness as information. Nope. He sees it as an opportunity created by everyone else's impatience. For him, patience isn't just some nice-to-have virtue. It's literally his core financial strategy.
So let's get specific. What does he actually ignore versus what he reads? It's fascinating. He's deliberately tuning out all the stuff most people obsess over, the S&P 500's daily ups and downs, the non-stop alerts from CNBC and Bloomberg, what the Fed is going to do. All of that is just noise to him. Instead, he's digging into the real stuff. The 10K and 10Q filings, think of these as the super detailed, no-fluff report cards a company has to file. He reads earnings call transcripts to hear what management is really saying. See the pattern? He's reading the business, not the stock.
Okay, so if he's not looking at the daily stock price, what is he looking at? Well, this leads us to what might be the single most important concept in his entire playbook, the massive difference between price and value.
And boom, here it is. Price is what you pay, value is what you get. This little sentence is the key that unlocks everything. See, the market gives you a price every single second of the day, and that price is all over the place, right? It's driven by fear, by greed, by some headline. But the value, what a business is actually worth, that's a whole different number. And the name of the game is to never, ever get those two confused.
So, how does he actually use this gap between price and value? It all comes down to this idea he learned from his mentor, Ben Graham, the margin of safety. And look, this isn't some complex financial jargon. It's just a buffer. It's a safety net. I love this analogy. It's like building a bridge that can hold a 30-ton truck, but you only ever drive 10-ton trucks over it. That huge difference? That is your margin of safety. It's the discount that protects you if you made a mistake in your calculations or if, stuff just goes wrong.
And here's a perfect real-world example of this in action. Let's go back to 1988. Buffett had done his homework on Coca-Cola. He figured out what he thought the business was really worth. And then he waited. He waited until the market panicked and offered him the company at a more than 35% discount. That wasn't just a sale price, that was an enormous margin of safety. It turned a great company into an almost no-brainer investment.
But here's the thing. Getting a cheap price isn't the whole story. The business you're buying has to be spectacular in the first place. And this brings us to one of Buffett's most famous ideas, his metaphor for a company's competitive advantage, the economic moat.
He literally thinks about it like this. A great business is like a big, beautiful castle filled with treasure. And in a capitalist economy, you can bet that competitors are going to be showing up every single day trying to breach the walls and steal that treasure. The moat is whatever protects that castle. It's that unbreachable defense that keeps the bad guys out and lets the business thrive for decades.
So what are these moats in the real world? Well, they come in a few different flavors. You've got the power of a brand. Think about Coca-Cola or Apple. Then there's a huge cost advantage, like how Walmart or Costco can just crush competitors on price. You've got switching costs. How much of a pain would it be for your entire company to ditch Microsoft? Impossible, right? Then you have the network effect, where something like Visa or MasterCard gets more and more powerful the more people use it. And finally, sometimes the government just sets up a barrier for you, creating a regulatory moat. The bottom line is, Buffett isn't just looking for a nice little business, he's looking for an economic fortress protected by one of these deep, wide moats.
All right, so let's say you've done the work. You found an amazing business, it's got a huge moat, and you figured out what it's worth. So when do you pull the trigger? This is where the psychology comes in, and it's pure genius. He waits for absolute panic. Just look at the track record here. It's the same story, over and over again. The brutal bear market in '74, the Black Monday crash in '87, the global financial crisis in 2008, even the COVID crash in 2020. Every single time the world felt like it was ending and people were dumping stocks like they were toxic waste, Buffett was the one on the other side of the trade, calmly buying up incredible businesses at bargain bin prices. For him, widespread fear isn't a reason to sell, it's the ultimate buy signal.
Now let's be absolutely clear about something really important. He is not trying to catch the exact bottom. Nobody can do that. That's a fool's game. His goal is much, much smarter. He's just waiting for that moment when you can feel the irrational fear in the air, when prices are being set by pure panic, not by logic, because that's the moment the gap between price and value becomes a canyon.
Okay, we've gone through all the core ideas, so how do we actually put this all together? Let's try and boil this down into a simple toolkit, a way you can start thinking like Buffett, like a true business owner.
So when it comes down to the final decision, how does he do it? It's not magic. It's actually a super simple but incredibly powerful checklist. Before he even thinks about putting money down, he makes any potential investment past these 5 essential questions.
And here's the checklist. Number 1, do I actually understand this business? He famously stays away from things he can't explain simply. Number 2, does it have that durable, protective moat? Number 3, is the management team smart and, just as importantly, honest? Are they using the company's cash wisely? Number 4, is the price right? Is there a significant margin of safety? And number 5, the big one, can this thing compound for me? Can it just sit there and grow for years and years? It's just such a clear and effective way to make a decision.
So, where do you even begin with all this? Well, here's a simple roadmap. Step 1. Build what Buffett calls your circle of competence. Just pick 1 or 2 industries you find interesting and go deep. Step 2. Start reading those 10K annual reports. Read them like you're a detective looking for clues. Step 3. Take a stab at estimating a company's real intrinsic value. Step 4, and this is the toughest part for most people, you wait. You wait patiently for the market to give you a great price, say a 25% discount or more. And finally, step 5, once you're in, you buy and you hold. Your main job becomes ignoring all that daily noise.
So we end up right back where we started, with this incredibly powerful quote. At the end of the day, Buffett doesn't read the market like a day trader. He reads businesses. And then he just sits back and lets the market's wild mood swings, its incredible impatience, serve up those amazing businesses to him on a silver platter. It really boils down to a simple choice, doesn't it? A question we all have to ask ourselves. Are we going to be the impatient ones or the patient?